Welcome back to FX Street. Great to see you here. Today is Tuesday, September 29th, 2009. Welcome back, one and all. Great to see everyone here. My name is Adam Rosen. I'll be the host for the next 45 minutes or so. Very special thanks to FX Street for hosting this webinar. We're certainly glad you can join us. We're certainly glad it's such a big room today. Wow. We have a very fun topic to talk about today, and it's very timely because we're coming toward the end of September and the beginning of October. Specifically, what we're going to talk about is corporate earnings season. Corporate earnings season occurs quarterly every 3 months in January, April, July, and October, when the majority of the U.S. and overseas companies report their quarterly earnings, and this has a very dramatic effect to the foreign exchange market, to the equity markets, and to other related markets as well. Now, you should see in front of you a chart. The symbol is YM. That's a future symbol for the Dow Jones Industrial Average. Please let me know if my voice cuts out or if you can't see the chart in any time. However, without further ado, let's get started. Now, the first page that I want to bring your attention to is a very neat website, www.earningswhisper.com. That's the site. Now, this is a free site that I've used for many, many years, and it essentially lists all the major companies, publicly traded companies in the U.S., their quarterly earnings, when they're expected to release, and the expectation of those earnings. Now, specifically, if you zoom forward to this link, you'll notice the first link I sent you is earningswhisper.com, and you can click on the calendar button on the left-hand side, and that'll list the corporate earnings that are scheduled to be reported today. You'll notice that the list is probably rather small. However, if we move forward through the month of October, through the middle of October specifically, the list starts to grow, and we will see the majority of the U.S. companies are scheduled to report earnings through the month of October, specifically towards the second and third week of October. This can have a dramatic effect to the market because this adds volatility, it adds volume. The stock markets, the equity markets, which is also known as the stock market, and the foreign exchange market, as it's connected to the stock market, as there's a correlation, they tend to exhibit a greater amount of volatility, a greater amount of volume as the big players, the mutual funds, the institutions, the hedge funds, buy and sell in order to square off their portfolios based on what the corporate earnings say. eBay expects better than anticipated earnings. Maybe mutual funds will buy eBay and add to the portfolio. Alcoa is expected to miss their corporate earnings, while hedge funds may sell short Alcoa and other Dow components. But with that said, we're taking a look at the Dow Jones Industrial Average chart. I'm going to throw in a very, very simple indicator. It's something that's used all the time, known as the Bollinger Bands. Very simply, it's a 20 simple moving average, center line, plotted 2 standard deviations above and below that simple moving average. Now, without calling any trades, the Bollinger Bands is a very, very effective tool simply to note the relative state of volatility. Notice where the mouse is looking towards the end of June, the beginning of July. Notice the width of the Bollinger Bands, the lower band to the upper band. If we place the mouse here, we can see the low of, this is July 9th, by the way. The low is around 8,029. The high during the same period of time, 8,683, about a 600-point difference between the two. However, moving forward, let's move forward to the beginning of August. And we see the low band, the lower band, and the bands tend to expand under periods of greater amount of volatility. Greater amount of activity spreads these bands apart. When the candlesticks and the market volume or volatility or activity shrinkens or decreases every day, the bands tend to decrease and move towards one another. Well, anyway, during the brunt of our corporate earnings, the end of July, the beginning of August, we see the lower band at 8,000 and the upper band at 9,500. So we went from a spread run, 600 points to around a spread of 1,500 points, 600 to 1,500. And this simply reflects that every single day, every trading day, which is reflected as every candlestick tends to increase. The candlesticks become longer. The volatility becomes greater. Now, why is this important to us as foreign exchange traders? Well, very simply, as volatility tends to increase in the stock market, volatility also tends to increase in the foreign exchange market. After all, there are very strong correlations that exist between the stock markets and foreign exchange markets. The most obvious correlation is a correlation between the low-yielding currencies, like the dollar and like the yen and like the Swiss franc. Those currencies tend to do well when there is fear in the market, when there is pessimism in the market. When the stock markets go down and all the traders and investors, they start to lose money in their long positions, they start to sell short, or they start to just get out of their positions, or if they do nothing, they just see the profit and loss statements go down. Well, this creates a certain amount of pessimism, a certain level of pessimism. Well, as pessimism moves into the market, traders say to themselves, well, let's get out of everything high yield. Let's get out of everything speculative. Let's put our capital in something that's considered safer. Something that's considered safer are low-yielding currencies. Again, like the dollar, like the yen, and like the Swiss franc. Well, if we're going to take our capital out of those, if we're going to put our capital into those low-yielding currencies, we want to take our capital out of higher-yielding currencies. After all, every foreign exchange trade involves selling one currency and simultaneously buying another. Well, if we want to buy the lowest-yielding currencies on the list, well, the logic is that we would sell short or take capital away from the highest-yielding currencies on our list. That would be something like the Aussie. That would be something like the Kiwi. Those are the higher-yielding currencies. Those are also considered commodity-yielding currencies or commodity-based currencies. After all, a great amount of commodities, specifically what I like to call the hard commodities, gold and silver and copper, and a lot of those commodities derive from the Australia-New Zealand area. Canada is the largest crude oil to the U.S., so there is also a commodity correlation to the Canadian dollar. I would say not as much because the Canadian dollar does not have as high a yield as the Aussie and the Kiwi, but still the correlation does exist. Now, everything else in the middle, whether we're looking at the pound or the euro and the Kiwis, and to a lesser extent, the CAD. By the way, if we lose audio at any point, please do let me know. Okay, excellent. All right. Thank you very much. And then we're back. Going back just a moment, in case you missed any of this, to restate, again, when stock markets tend to go down, capital comes out of high-yielding currencies, like the Aussie, like the Kiwi, to a lesser extent like the CAD. Capital tends to move into the lower-yielding currencies because low yield is indicative of a safer currency. After all, if U.S. interest rates are nearly at zero and Japanese rates are nearly at zero, there's just so far we can cut the interest rates even further down to any extent. Okay, turning up the audio just a hair already. Now, the point of this webinar is what we want to do is identify the trades, the probable trades that will occur during the October earnings season. The ideal trade, what I like to call the perfect storm of currency trades, is when we buy one currency and it goes up, and we sell short another currency and it goes down. That creates the real trend. Now, if we have two currencies that go up at the same time, or two currencies that go down at the same time, the chart that we'll see in front of us will look range-bound. Rather lately this is actually a different case, but over the long term, the euro-yen, and we'll take a look at that chart, has been very, very range-bound. That's because coincidentally, or maybe not coincidentally enough, due to the very low yields, the euro and the yen have both moved up together. The euro and the yen have both moved down together. That has created a very range-bound market. On the other hand, we look at a currency pair like the Kiwi dollar, the New Zealand dollar against the US dollar. That has become very, very trendy, trading at near 1 year, actually more than 1 year highs now. That is because the dollar has been going down, 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 and the Kiwi has been going up, up, up. That is what we're looking for. We're looking for a trending market. Ideally, again, we want to buy one currency that is going to go up the most and sell short the other currency that's going to go down the most. But first of all, let's take a look at our Dow Jones Industrial Average chart. Let's mark off horizontal lines where it appears this move during July started. Now, we say it's July, but the actual corporate earnings, if you take a look at earningswhisper.com, actually starts well within the month of July and extends about 1 or 2 weeks into the month of August. But roughly July is considered to be that volatile trading month. Well, as we see, the Bollinger Bands began to expand. I drew a vertical line on July 13th. Because that was the first really strong green candle that led to a very, very big trend to the upside. Just refreshing the camera there. Please let me know if you can't see it. At any rate, the first vertical line, again, is marked off July 13th. And this notes the first really strong green candlestick that we saw on the Dow Jones Industrial Average before the volatility really took off. As we move forward just about a month or so when this trend hit its high. Coincidentally, or maybe not coincidentally enough, August 13th, exactly a month later, marked the highest high that we saw before an eventual pullback. During that period of time, the Dow Jones Industrial Average from July 13th moved from a low of 8,014 to a high of 9,426. That's about 1,400 points, Dow Jones Industrial Average in one calendar day, which is about 20 trading days. That is a very, very big move. To compare and contrast that, it's following the next month from August 13th to from August 13th to September 13th, the Dow Jones Industrial Average went from a high of 94.26 to a high of 96.43. It only went up about 200 points more. And the fact that we were to measure the low to the high, it went from about 9,100 to a 9,600. That is about another 500 points to the upside. So we can see the real dramatic move occurred from the second week of July through the second week of August. This is most notably marked by the corporate earnings that were released. Now let's remember those dates, July 13th to August 13th. Now let's go to some of our foreign exchange charts. Now we're looking at the pound-dollar daily chart now. Please let me know if you do not see the pound-dollar daily chart. I'll be more than happy to refresh the chart. Let's mark off again. August 13th, that's the high. July 13th and August 13th. I'm going to mark off two vertical lines marking the beginning and the end of the official earnings season. Now, again, I consider earnings season from July 1st to July 31st, but the corporate earnings schedule is always a little bit different. But without drawing any further lines, well, I can draw one further line. Let's do this. Let's mark off the significant highs or lows that the market was able to achieve before corporate earnings began. And notice over here, from around June 1st with the bounces until around July 13th, we had a very, very range-bound market. The market failed to make new highs or new lows, and it was probably very frustrating because traders who probably bought new highs, buying that breakout, well, we were caught on the wrong side of the market. And traders who sold short a breakdown, maybe a little bit of a new low, we were caught on the wrong side of the market as well. However, during the month of July, during the corporate earnings season, the market lifted to new highs and moved from a high of around 167 to actually highs around 170 or change. Another 400, 300 pips to the upside. Now, the pound dollar, in my opinion, is not the best currency pair to go through and analyze this nuance or this phenomenon in the market, because there's always a different story with every currency pair. You know, we run through whether it's manual trading strategies. If I use, let's say, the RSI or the MACD or the Bollinger Bands, it may work very, very well on a pound dollar during the month of July. It may work very, very poorly on a euro pound chart during the same period of time. Then again, it may work well on an Aussie yen, but not on the Kiwi yen. Why is that? The foreign exchange market is always constantly changing. You see, UK interest rates, now close to zero, were near the 4 and 5% level a couple of years ago. But more importantly, the anticipation of higher, lower rates is constantly self-adjusting. The market, meaning you and I and everyone else buying and selling these currency pairs, is constantly self-adjusting. It's always adjusting. We never thought that U.S. rates maybe would be taken this low, but now they are. But looking back a year ago, maybe some of us would have guessed, hey, the U.S. would have started to raise rates already. Maybe, maybe not. However, now reading recent statements, actually an article I read earlier on Bloomberg today, it's now very much anticipated that the U.S. may not raise rates anytime soon at all, meaning until the end of the year, maybe even well into next year. Well, that anticipation, today's rejiggering of the market, so to speak, the reanalysis of the market that takes place every single day, that causes the dollar to go down today and tomorrow, and may cause the dollar to go up again on Thursday and maybe on Friday. It's always a self-adjusting market. So it's important to understand that the pound-dollar pair, the pound-dollar chart that we see now today, is a very, very different financial instrument that what existed a few years ago when the Bank of England said, we're not cutting rates, we don't see any problem with the market at all, we don't see any problem with the banks at all, And while in the same period of time, the FOMC, the Federal Open Market Committee in the U.S., said we're cutting rates, we cannot cut rates fast enough, and we're probably going to have to cut rates a lot more. And that really caused the pound dollar to go up, 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 as capital moved out of that lower yielding dollar into a higher yielding pound with the anticipation that this would just continue to occur over and over again. Let's get to some better examples though. Let's take a look at the Aussie dollar. And again, we're going to mark off those levels that we mentioned earlier. Remember, it was July 13th. I'm going to mark off that vertical line. I want to say horizontal. That vertical line, July 13th. And then we're going to mark off August 13th. And let's see what occurred right before earnings season, as defined by these two vertical lines. And let's see what happened afterwards. Well, let's pretend that we did not know what would happen, what did happen. We didn't know what was going to happen between these two vertical lines. So if we did not know what happened, I would have drawn a downtrending resistance line connecting to significant highs. Probably would have drawn a downtrending support line in a parallel fashion connecting to significant lows. And we see what did emerge was a very predictable range-bound market. Now, if we ignore everything that occurred after the first red line, from the first red line, which is July 13th, let's pretend we don't know any of that occurred. All we know over here is in the Aussie dollar is in a steady trend to the downside, lower lows, lower highs, and we say beautiful. It probably looks like a short. Hey, we can explain this fundamentally one way or the other. We could have said at the time that the Reserve Bank of Australia had maintained rates much higher and probably they have a lot more to cut, while the U.S., the FOMC, has cut rates already so much that maybe they're poised to raise rates soon. Well, if we would have explained that fundamentally, in fundamental analysis, we can always sort of change our opinion to fit the chart. It's kind of a dangerous thing to do. But regardless of that, we would have said, hey, the trend is your friend, downtrending markets. Therefore, I want to only look for orders to sell shorts. Well, if I want to sell short, I want to sell short as close as possible to the highs. Hey, it's a good risk-reward ratio, right? Well, that would have led me to believe to sell short if the market had come up and tested our downtrending resistance. The last resistance spot before this red line occurred was around 81, 81 and a quarter. Well, 8100, selling short, the recent lows were down near 77, a nice 400 pip potential profit, taking a 1 or 200 pip potential risk. That would have given us a very nice risk-reward ratio and a very nice trade. But what happened? If we had then said, well, let's take a step back. We just got out of a very slow trading month in other words known as June. June is known as a very slow summer trading month. A lot of traders go on vacation. A lot of traders just don't want to do anything in the market. Why? Because there's a lot of range-bound activity and not a lot of trends. However, as we started in July, we noted the potential of a breakout. This first breakout actually occurred July 20th. Well, taking a look at our earnings calendar, say, hey, it's July 20th, and we have a lot of corporate earnings being released. We have the big Dow components like GE and General Motors and Exxon and Chevron and you name it. Well, that's part of the same now anyway. Walmart, whatever company we decide to watch, chances are they reported earnings within the first few weeks of the month of July. Well, that tells us, hey, in the month of July, this really means something. This means a lot more than it did when we made slightly lower lows July 8th, the end of June, as the market established a long candlestick to the downside and then quickly retreated back to the upside. Point being, and I think the simplest way to say this, is that note the period of time on the calendar, on the yearly calendar, when potential breakouts and breakdowns, when you suspect they may occur. The reason being, if they occur during the earnings season, January, April, July, and October, it means a lot more. Why? Because there's a lot more participation in the market. We have, congressional elections in the U.S. coming in another year or so in 2010. Well, if I were, as a silly analogy, if I were to poll, let's say everyone in this room, we have 57 people in this room, let's ask everyone who they're going to vote for, Democrat, Republican. Well, I'm not going to ask you. But if we were to ask 57 people, would that result of our poll, of our internal FX Street poll, would that be statistically relevant to the entire U.S.? Probably not. However, if I were to poll every single registered voter in the United States, 300 plus million Americans, who are you going to vote for, Democrat or Republican? The results of that poll would be much more statistically accurate. Why? Because we have a greater pool. We have a greater amount of voters that are going to give us their answer. Well, the same thing holds true. after all, how relevant is a poll if we don't ask so many people? Well, in June and in August and in part of September, we really don't have a lot of voters out there. In other words, we really don't have RD, you said the exact word I was looking for, random sample. Thank you very much. The traders that are involved, the volatility and the volume that's involved in the market in the quiet trading months, specifically the summer trading months, May, June, August, September. Notice I left out July, that's corporate earnings, August and September as well. That is not as statistically accurate. However, when the Aussie dollar makes new highs, July 20th, in the middle of the brunt of the most active earnings season, which is July, I would say number 2 is probably October, by the way. I would say that's much more statistically accurate. There's a lot more voters out there. There's a lot more buyers and sellers, and that means we have a greater chance of being right. Well, let's move forward to the Aussie dollar. Let's pretend that we didn't know any of this happened, and we'll draw our support and resistance based on what we know now. Well, based on what we know now, we have a trading range in the Aussie dollar, 8,500 to around 8,800, 8,700 more or less. If the Aussie dollar makes new highs today, if we move up to 8,800, will that mean a lot? Probably not. If we make new lows today below 8,500, will that mean a lot? Probably not as much either. However, if and when this breakout were to occur in the brunt of October earnings season, that means a lot more. That means there's a majority of the market that's behind that vote, that's behind that buy or sell order, and we have a much greater chance of being right. And for long-term traders, or even short-term traders, if you want to catch the brunt of the market, the brunt of the move, my advice is to focus during these active period of times. In my former days, before I discovered the foreign exchange market, I used to be an equity day trader. And equity day traders, some of them, believe it or not, what they'll do, they'll focus only on these earnings seasons. They'll be very, very active in January. February, I remember as being a very bad month. March, here or there. April, I remember to be very, very good. July, by far, was the best month for stock traders, for day traders. That was typically considered to be the most active month. However, the end of July, the last week in July, the first week in August, by far, was the most dangerous week of the year. The reason being is because we become very, very accustomed to buying new highs or selling new lows, and the next thing you know, the volatility dries up. During the month of July, it's very, very easy to buy new highs or sell new lows and make money. I'm sure you've seen this in some of our currency pairs. After all, look at the Aussie dollar. In the month of July, if I had bought new highs, we would have made a move, well, from lows of 7,800 to highs of around 8,500. That's about a 700 pip move in less than 1 month. In about 3 weeks, we made 700 pips. Well, in the following 3 weeks, we barely made new lows. We did not even, maybe by a few pips, we made new highs. Notice how the volatility just absolutely shrinks. Remember, plug in the Bollinger Bands again. Notice how narrow the Bollinger Bands are during the month of June on the Aussie dollar, with a low band of 78.60, a high band of around 81.20. That's about, a 400 pip, less than a 400 pip range from low to high. Well, in the month of July, we went from a low of 7,700 to a high of almost 8,400, actually even more than that. So a 300-400 pip range turned into an almost 800 pip range and even more. However, notice the range that passed afterwards from 8,200 to around 8,400, 200 pip range. We went from a 400 pip range to an 800 pip range to a 200 pip range. Range means the low Bollinger Band to the high Bollinger Band. And again, these Bollinger Bands tend to expand during periods of greater volatility and contract during periods of lesser volatility. Now, with all that said, let us take a step back for a moment and let's talk about the foreign exchange market. Because we said the Aussie dollar pair that we look at today is not the Aussie dollar pair that we saw 6 months ago, and it's not the Aussie dollar that we may see 6 months from now. So moving forward, we know the number one driver of foreign exchange markets is the anticipation of higher or lower interest rates. Well, let's pick a currency, and I ask all of you now to chime in, if you may. What currency do you think will be the strongest currency in the month of October? Or what is the strongest currency right now? I'll give you my vote, but I think the strongest currency right now, and they say the trend is your friend, as long as what we see right now continues, TB said it, New Zealand dollar. New Zealand dollar by far has been the strongest performing currency of our 8 currencies. Now, what do we think will be the strongest currency? I very much may agree with you. It could be the Japanese yen. Let's take the status quo. Let's take what we know right now. We know right now the New Zealand dollar, and we'll go to a Kiwi dollar chart actually. This has been an unbelievable move. Talk about trading with the trend. The Kiwi dollar, you should see a Kiwi dollar chart in front of you, by the way. We went from lows of 4,900 at the beginning of March to highs just the other day of 7,300, the end of September. Let's say, so we're looking at a low, what did I say, around 49, actually a little bit below 49. We'll say 49. High of 72. That is 5,300 pips. Did I do my math right? No, I'm sorry, from about 50, no, not that much. About 2,200 pips, 2,200 pips. I did my math wrong. 2,200 pips from March, we have April, May, June, July, August, September. About 6 or 7 months, we made 2,000 pip move to the upside. It says a lot more considering the Kiwi dollar. The Kiwi dollar is not considered to be one of those currency pairs that is really a mover. But the New Zealand dollar by far is the number one performing currency right now. The dollar, by the way, has been, and I think this will change, but the dollar has been one of the weakest currencies on our list right now. Now I ask you, moving forward, let's pretend that the date is October 31st and we've survived all of corporate earnings and the world still spins on its axis in a semi-horizontal fashion. Well, with that said, what do you believe will be the strongest what will be the strongest currency? What will be the weakest? Now, I'll give you a couple, before you type in the answer, I'll give you a couple things to consider. Number one, the currencies move, the number one anticipation when currencies move is the anticipation of higher or lower rates. Well, what currency or what central bank governing that currency, what central bank do you think is most likely to raise rates between now and the end of the year? The reason why I say it is because if we roll forward to October 31st, we're going to start to think about the end of the year. Excuse me. And we're going to start to think about, hey, maybe the Fed will raise rates. Maybe the Bank of England will raise rates. Now, if you'd asked me this question a month ago, I would have said the U.S. dollar, like Bullet said. I don't think maybe not necessarily yet because of recent statements made by the Fed and recent Bloomberg articles that I read every single day. So I would have said the U.S. dollar, but maybe not yet. A couple months ago, I would have said the Bank of England because the pound has really been beaten down, and the governor of the Bank of England, his name is slipping my mind at the moment. If anybody remembers, please, Gordon Brown, thank you, has mentioned that the weak pound has actually really benefited the UK economy. Well, maybe not so fast. Gordon Brown is the Prime Minister. Mervyn King, thank you very much. So what central bank do we think is most likely to raise rates? I would not say the Bank of England. I would not say the FOMC in the U.S. I might vote for the euro because higher commodity prices has certainly led the European Central Bank to raise rates. Now, Bola also mentioned the Aussie, and if anyone has mentioned that also, you may be correct in the Kiwi. These currencies already represent high rates. Well, a currency like the New Zealand dollar, like the Aussie dollar, that already has 2.5% to 3% interest rates, even if they do nothing, it's a carry trade. We're making, if we buy the Kiwi or we buy the Aussie and we sell short the dollar or we sell short the yen, if nothing changes, if everything is the way it is, if everything will be at the end of October the way it is right now, we make money on the carry trade. ATB, that's exactly right. Taking a look at, and I'll take a step back and say this again because I think it's so important. Taking a look at the macroeconomic fundamental view of the foreign exchange market. At the end of the day, if we take a really big step backwards and take a look at the foreign exchange market overall, the number one reason why foreign exchange currencies move is the anticipation of higher, lower rates. Now, why do I buy some currencies and sell short other ones? Me as a long-term macro fundamental monthly chart-based trader, well, I buy currencies with higher yields and I sell short currencies with lower yields. The very simple example is that if I were to go to New Zealand and I were to, let's take a trip to Japan. Let's take a trip to Japan. While we're in Tokyo, I'm going to take out a loan. I'm going to take a loan for $10,000. $10,000 worth of yen. It's a lot more yen. Now, I'm going to take out that money, I'm going to stick it in my suitcase, I'm going to get on the plane, I'm going to go over to New Zealand. Well, I'm going to deposit that capital, that worth of $10,000, I'm going to deposit it into my New Zealand savings account. Well, the loan I have to pay in my Japanese loan, the bank account there, well, Japanese rates are almost close to zero, basically at zero. So our interest rate is very, very low. Harley said the best way, higher interest rates attract money to the country. That's what I'm trying to say in a very easy way. However, if I were to take the 10,000 notional dollars and put it into my New Zealand savings account, I'm going to get a lot more interest. Well, if I'm making like 3% in New Zealand and I'm paying almost nothing on my Japanese loan, the difference, that 2-point-something% difference, I keep. That 2-point-something% difference is called a carry trade. And that is, like Harley said, the reason why capital moves into some currencies and out of others. Now, with that said, do I think the Reserve Bank of New Zealand will raise rates next month? If I do, and I have not already bought New Zealand dollars, maybe I should now. Because what's better than owning Kiwi at 3%? Owning Kiwi at 3.5%. Now, the foreign exchange market, like any market, is a forward-looking mechanism. It's made up of traders, you and I, and everyone put together, always trying to guess the next step. If I think Kiwi rates will be 3.5% this time next month, I'm buying it now. Because I want to buy it before you think that we're going to 3.5%, and everyone else thinks we're going to 3.5%. I'd rather be a little early than a little late, so to speak, on a fundamental basis. That is the reason why, on a grand scheme, why the foreign exchange market moves. The anticipation or the expectation of higher or lower interest rates in the future. Now, the dollar has been weak for quite a long time. It's near its very extreme lows, near its one-year lows against a lot of currencies. Now, Bloomberg earlier today during the European trading session, they published an article, and the analyst, I cannot recall the name offhand, but the analyst said, you know what, based on recent economic data, it's now anticipated that the FOMC, the Fed in the U.S., will not raise rates by the end of the year and may not raise rates until sometime next year, 2010. Well, we all know that publications, Bloomberg.com, as great as they are, and they are sometimes late. I think it could be a case of buying the rumor, selling the news. That the analysts now have come out and said, you see this U.S. dollar weakness? I know the reason why. The reason why is because the market does not anticipate the Fed to raise rates. Well, that's all very fine and dandy, but where were these expectations 6 months ago or 3 months ago before the U.S. dollar absolutely got crushed and went to one-year lows against a lot of currencies? But the fact remains that the market moves under these buying and selling pressures. Now, to answer my own question, I would say, well, taking a look forward next month, I would say that I think the strong currencies will continue to outperform the weak currencies. Because after all, if I can make a 2.5-3% carry trade, buying new Kiwi dollars and Aussie dollars and Kiwi yen and Aussie yen, I don't think that carry trade is going to disappear anytime soon. I don't see the Fed or the Bank of Japan raising rates by 3% anytime soon. And I don't think, based on recent data, especially out of Australia, they have been very, very optimistic out of their last few Reserve Bank of Australia statements or central bank meetings. They've been very optimistic. I don't think that they're going to cut rates anytime soon either. So my answer would probably be the Aussie dollar, Kiwi dollar. However, before I cast my final vote, I would say this. Note the correlation, again, that we mentioned between the high-yielding currencies and the Dow Jones Industrial Average and other equity markets. The real answer, and I think the proper way to answer this question and to vote, is to consider what do we believe will happen with the stock markets over the next 30 days. Do I believe the stock market will go down? Do I believe the stock market will go up? Now, those of you that have been around the financial markets for a while, I'm sure you remember Octobers of previous years. Octobers have not been known to be good months for stock traders. There was an October, well, it was back in 1987. That was not a good month. And remember October of last year. That was not a good month either. If the stock market goes up, the dollar weakens RD, September as well. You are correct. September has been a pretty ugly, historically has been a pretty ugly month for stock markets. Now, lately the stock market has been kind of flat. However, to answer your question, RD, yes. Currently, Under the current situations, yes. When the stock market goes up, the dollar tends to weaken because it has to do with the very low yield that we get in the dollar versus the very high yield that we get buying stocks and buying higher yielding currencies. Point being is that the way to explain this is that, again, it goes back to, are we optimistic or pessimistic? If we are optimistic, we buy stocks because we think the stock market's going to go up. If we're optimistic, we also want to buy higher yielding currencies. Well, if I have my choice, I'm going to look at my trading platform and I say, well, I can buy the Kiwi, I'm going to make 3%. I can buy the Aussie, make 2.5%, or I can buy the US dollar and make almost nothing. If I'm optimistic, I want risk because risk is good. Risk is good when things go up because risk equals return. However, when the stock market goes down, when pessimism returns in the market, risk equals losses. Well, Ed said, I did well in September, October of 2008. Was I lucky? Not necessarily. If you did well in September, October of 2008, first of all, I congratulate you. However, every October, every September is different. Now, when I say bad or good, I typically refer to it in terms of the average stock investor who only trades to the long side. I mean, they only buy stocks. I would say most traders out there, most investors out there only buy stocks. Very few on a percentage basis actually sell short stocks. We leave selling short stocks to the hedge funds out there, to the savvy traders out there, and of course to all of us because we know what we're doing. However, most investors out there that just buy stocks in a mutual fund, and mutual funds are not allowed to sell short also. Most of us just buy stocks. So historically, if we were to look at a trader's almanac and say, well, how has October been? I would say just offhand, I'm guessing October has been rather weak as opposed to rather strong. The question is, if gold is not driving the Aussie dollar so much now, what is the weaker dollar? Well, the weaker dollar certainly is driving the weaker dollar certainly has driven the Aussie dollar higher. Let me go to an Aussie dollar. Did I go to an Aussie dollar chart already? I did. Let's go to another one because we're talking about commodity here. Here's the dollar CAD, by the way. I'm going to get to this chart in just a moment. What has driven the Aussie dollar higher? Two things, a weak dollar and a strong Aussie. Well, gold, I'm glad you mentioned it. Gold came very, very close on the futures basis to hitting new historic highs, $1,032.60. My charts indicate that's the highest high. So gold, actually, historically speaking, is very, very close to its highs. Its all-time highs are around 1,032, and last time I checked, we're around 990. So historically speaking, gold's actually very strong. But taking gold and other commodities out of the market, Aussie, I believe, and this is my opinion, take it with a grain of salt, but I believe the foreign exchange market, the majority of the market, when it looks at Aussie, it doesn't think of gold and doesn't think of silver. It thinks of the currency in terms of its yield. Where are Aussie yield right now? 2.5% the last time I checked. I'm embarrassed if I'm wrong. Around 2.5%. Well, the foreign exchange market says, hey, we have Aussie 2.5%. We have the dollar at almost zero. We have the yen at almost zero. Where am I going to make more money? I'm going to make more money buying higher yield, buying the Aussie, and even better than that, buying the Kiwi. But gold has driven the Aussie. I would not say, and gold does have a very strong correlation to the Swiss franc, but I would not say it has as strong of a correlation as the simple nature of high yield versus low yield. At the end of the day, I would put that as number one on the list of the reason why foreign exchange moves on the macro grand scheme. Now, of course, we have non-farm payrolls coming up at the beginning of the month. We have a lot of other economic numbers scheduled to be released. On a micro, day-to-day, minute-to-minute basis, there are other factors which move the market. But, Second Skies agrees with me. I love it. But, if we look at a macroeconomic picture, the fact of the matter is it's a yield differential. I couldn't have said it better myself. Let me get to the dollar CAD chart because we've mentioned Canadian dollar as being a commodity currency as well. However, Canadian dollar is not so easy. The reason being is that when we talk about the Aussie and the Kiwi, we're talking about high yield. There's my July 13th level line and mark off August 13th while I talk and draw. Okay. Notice the market, by the way, excuse me, the dollar CAD had been going up, 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 up. Let's pretend we didn't know what was going to happen in the month of July. I would have drawn an uptrending support line. This looked very, very good and looked like it was never going to stop. However, the market broke down, and again, because this breakdown occurred July 13th, And if you look at the Dow Jones Industrial Average chart, remember we marked the vertical line at the first big green candle? That was the first candle. And I'll go back to the Dow chart just to remind everyone what it looked like. The first huge candle that we saw. Let me get rid of a whole bunch of ends. Okay. Notice the vertical line on the left-hand side. That is July 13th of this year. That was, I consider, the beginning of the most current trend. It was a first huge candlestick to the upside, followed by 1, 2, 3, 4, a lot of green candlesticks to the upside. Again, that's July 13th. Remember July 13th? We go back to the dollar CAD chart, and with this first big red candlestick that broke our uptrending support line, and the first big red candlestick in a while was also July 13th. This represents the first big up day in the Dow Jones Industrial Average, the first big down day in the dollar CAD. This really solidifies our basis that Dow Jones Industrial Average goes up and the dollar goes down based on the very low U.S. dollar yield. Now, zooming forward 3, 4, 5 years or however long it takes, and notice, by the way, as I interrupt myself, we broke from highs around 116, 117 very quickly down to 106. That's 1,000 pips in about 2 to 3 weeks. That is a very, very big move. That trend certainly did not exist. Well, it did beforehand to a lesser extent, but that was a very, very big move. Now, notice, since the end of earnings season, August, till now, we've arranged on market. Let's forget everything we know about the dollar CAD in the past. And this is a real point of this webinar today. Take a look at everything that's happened in August and September. Take it into consideration and kind of ignore it. Kind of forget it. Because now what I'm looking for is the next big move. Number one, the next big move, the next real daily chart breakout. Breaking to a new high, breaking to a new low. Number two, I want this move to occur in October and not October 1st. I would really rather it occur towards the middle of October. Because if you take a look at that website that I sent forward before, earningswhisper.com, just note the big companies. The big companies are the Dow components. General Motors not so much anymore. GE, Boeing, DuPont, the big Dow components. Go into Google and Google Dow components and you'll see those 30 big names. Plus, we have those big names in the S&P 500. You don't even have to look at Google to know who they are because you probably use them every day. Apple, eBay, and Amazon, well, maybe Google. Those are the big names. So we want to look to see when those companies are scheduled to report earnings because eBay is a lot more significant of a reporting than what used to be Pets.com, which is now, by the way, out of business. Question is, Ed says, with huge tuning pound dollar, I don't see long-term value and the Fed doesn't have a defined exit. UK think will use for a short-term fix, but they will soon jump in the euro. Well, I'm glad you brought it up. It's a great point. This has been, if you were to ask me what has been one of the most traumatic moves in the foreign exchange markets over the past month, some of you may say the Kiwi dollar. I would tend to agree with you. Some of you may say the Aussie yen. I may agree with you also. But this, I think, has been the biggest move. Why? Because normally this does not happen. Euro, pound. Euro, pound. When you have two currencies that typically come from the same geographic, political area, meaning euro and pound, which typically what's good for the euro is good for the pound, what's good for the pound is good for the Swissy because they all tend to benefit from the same, under the same geopolitical pressures. Macroeconomic pressures, I should say. This is known as range-bound markets. Notice what happened with the euro-pound breaking 8,800 highs middle of September, and then with 1 week going from 8,800 to 9,300. Remember, in the euro-pound, we make more than $1 per pip on every mini lot, almost $2, depending on the interest rates. This is a huge move. We moved up 400 or 500 points on the euro-pound. Was it 4 or 5? 88 to 92, about 400 or 500 points, up to the 78.6% Fibonacci retracement level, breaking above its downtrending long-term triangle consolidation pattern. I don't know if this can continue, but this was certainly a huge, huge move, and this is mostly pound weakness. I think the pound, if you'd ask my general opinion, ignoring all charts and everything, just looking at the dramatic move, I think that there is a good possibility of a pound bottom. I don't know if it's going to be the permanent bottom, but at least somewhat of a bounce. Maybe we already saw that bounce a couple days ago. But getting back to, I think, really what the point, as I have about 2 seconds left on our webinar, point being is this. As we enter October, I want to look for breakouts because the breakouts can lead, on the daily chart breakouts, can lead us to the next really, really big move. And again, we have to look no further than the Kiwi dollar. Let's mark off the July trading range as we broke out to, and we see this represents roughly, we had a range-bound market in June during the quiet summer months, May and June, and then the Kiwi dollar broke out above 65.70. Now it's 71.50. That's at least 400 pips, and actually more than that. Most of these sharp, fast moves occur during earnings season and tend to follow through. And the last thing I'll say is that if you're a short-term day trader, please don't tune me out because this also applies to you. If I'm a short-term day trader and I see a market that's very, very range-bound, and I see in the beginning or middle of October a sign of a real, true daily chart breakout, I only want to trade in the same direction as the trend as that breakout over the next ensuing month, because I think the potential is we're going to see another very, very big move. And one last thing about October, it's a very unique earnings season, different than January, different than April and July, because a lot of our mutual funds, a lot of our institutions, and a lot of our individuals take profit on profits we've made in the stock market. We've made a couple points in Apple. We've made a couple points on other stocks. We take profits and we sell them before the end of the year, and we buy them back at the beginning of the year for tax purposes. And for that reason, the end of the year, we usually have this end of the year tax selling period. And that's why markets are usually kind of weak towards the October earnings season. But please be aware that the correlations that exist in the stock market, fueled by corporate earnings, have a direct correlation to the foreign exchange market and can really help to put us with a little bit of foresight on the best side of what could be the next really big move to come. With that said, I am out of time. However, I do want to thank you all very, very much for joining us. If you want to contact me directly, please do not hesitate to do so, www.forex.com. And I thank you all very much for joining us. A very special thanks to FX Street. Please see the calendar because I'll be back on next month with much, much more. Again, we thank you all very much for joining us. We wish you a great day. All profit and trade. And we look forward to seeing you back inside FX Street.